Welcome, options traders. Hello, everyone. I received another great question from one of the traders in our forum here saying, I seem to have gotten locked out of my account and the broker says I did some kind of a free ride or something. I have no idea what they're talking about. Could you please help me to understand this? So free rides and liquidations is a related issue, are quite common for those who trade shares of stock. And although I normally don't cover this in options forums, it does lend itself to another case for using options because you'll find out you're not going to have these issues if you're using options. So I thought it would be appropriate for everybody, and we also probably still have some stock investors out there, to understand these two kind of hidden quirks about the stock market. So let's take a look at free rides and liquidations. First of all, understand that when you open up a brokerage account, whether you're trading shares of stock or options, anything, they're going to ask you what type of account that you want. And if you're trading shares of stock, you basically get two choices. You can open up a cash account or you can open up a margin account. And technically, you can even have a cash account inside of a margin account. Now, if you're trading options, they must be in a margin account. So if you don't remember opening a margin account when you were applying for options, that's why it's a default. You have to have a margin account. But for those of you who are trading shares of stock, that is not true. You have the choice of opening a cash account or a margin account. And as we're going to find out, these issues with free riding and liquidations occur in a cash account. So to understand this, we need to back up a little bit at some of the financial regulations, and one that is called Regulation T, usually called Reg T for short in the financial industry. Regulation T is an extension of credit that is given to the brokers. So a lot of these rules and regulations fall under this regulation. So if you open up a cash account, you check off this little box that says, I just want a cash account. What that means is that all of your transactions must be paid for in full. You can't margin them. You can't pay for half of it and to, borrow the rest. They got to be paid in full. A margin account, on the other hand, does allow you to pay 50% down, which is called the Fed call, and borrow the remainder. That is subject to a $2,000 minimum, so if you bought $3,000 worth of stock, you can't have a $1,500 Fed call. You would have to have at least $2,000 minimum. But if you do, you're only required to pay 50% down, and then you will automatically borrow the remainder. So for instance, if you buy $10,000 worth of stock, you'd only be required to pay $5,000, and you will immediately borrow the remainder of the $5,000 as part of the agreement. Almost like a credit card. There's no additional paperwork. It just happens automatically. And that is called a margin account. So the thing to understand with a free ride is that it will only occur in a cash account. And this is why you have to be careful whenever you're opening up cash accounts. So remember, with a cash account, you must pay for the purchase of a security, fully pay, before selling it. And that's an important phrase right there. And that's why I've highlighted it in yellow. Remember, you must pay for it before you can sell it. Okay, so keep that in mind. Now, here's the way it works. If you sell before fully paying, you are free riding. And I know it sounds technical. I'm going to go through some examples here. But if you end up with a free riding violation, the broker puts your account on what's called a 90-day cash up front, or what's sometimes called a cuff in the industry, restriction. And that means that during that time, you can only sell existing positions. You can do purchases. I'll talk a little bit more about it later on in the presentation, but it would have to be fully paid for. So it really kind of puts the handcuffs on you when you get charged with a free riding violation. So that's what sets up the problem. People might have these strategies that they're setting up, they're averaging into positions, and suddenly they can't trade in their account. So how does this happen? Well, we have to understand that today there's what's called a T+2 settlement. And that's short for trade date plus 2 days. And back in the day, it used to be T+5, then they went to T+3, and just a couple of years ago went to T+2. So here's the way that it works. Let's say that you buy shares of stock on the 9th, on Monday. We don't count the trade date. So we don't count Monday, and we just count 2 days forward. So our settlement, T+2, would be on Wednesday. And all that means that that is the day that the funds must be in the account. Now, very few brokers allow you to do this anymore, but technically you could buy, let's say, $10,000 worth of stock on Monday, and as long as you have a check to the broker by close of business on Wednesday, it would be settled. But the thing that you have to understand is that there is this T+2 settlement, and it's this settlement that sets up all of the trouble for free rides and liquidations. So let's start off with an easy example, and let's say that you buy $5,000 worth of ABC stock, and then you turn around and sell it in the same day. Well, because the stock was fully paid for on the trade date, the investor may sell it any time. So whether you sell it today or later in the week, next month, next year, doesn't matter. It was fully paid for. You're free to sell it. So there's no problems of selling it provided you fully paid for it. Now let's start making things a little more tricky. Let's say that you sell $5,000 worth of ABC stock on Monday. You're doing that to generate the funds, and you're going to take that cash and buy $5,000 worth of XYZ on the same day. Now, to make things easy, we're going to assume that you have no other securities in the account. We don't have a margin account. You're not going to be depositing more money. Obviously, all of those will change the answer. But the thing that causes the problem for people is when they're trying to sell a security to generate the cash to buy another one. Okay, so everybody with me, you sold $5,000 worth of stock on Monday, and on that same day, you buy the same dollars worth of a different stock. Is that okay to do? Well, think about your T+2 settlement. If we sell it on Monday and we buy it on Monday, when do those transactions settle? They settle 2 days later on Wednesday. So the proceeds from the sale will be in the account, so to speak, on the day that the requirement for the buy side is there. They will meet settlement. The funds will match. And that's because everything is going to land on Wednesday or T+2. All right, let's go to a little trickier example here. Number 3, let's say that you sell $5,000 worth of ABC stock on Monday, but now you buy $5,000 worth of XYZ on Wednesday. So in the previous example, we sold it and bought it in the same day. Same example here, we're just stretching it out to that you waited till Wednesday to make that purchase. Now at this point, this is okay because the investor would have settled funds on Wednesday. So graphically here, take a look at it. You sold your stock on Monday. You've got $5,000 worth of cash coming in. It's not there yet. It hasn't settled, but you've sold it. And on Wednesday, you jump into your account and you place an order to buy $5,000 worth of XYZ. That is okay. Why? Because the funds have settled. The proceeds from the sale on Monday landed in the account on Wednesday. So you were certainly free to do that purchase without any free ride violations. All right, so hopefully you're starting to see where things are going to go wrong. And that's what we're going to look at in this example. Let's say that you sell $5,000 worth of ABC stock on Monday, but then you buy $5,000 worth of XYZ stock on Tuesday. In a previous example, we assumed that you did them on the same day, sold and bought on Monday, or that you bought on Wednesday. Now we're doing it somewhere in between. We're selling ABC and we're buying this XYZ the next day on Tuesday. Now, at this point, it is okay because remember what the rule says. You cannot sell your XYZ stock without fully paying. It doesn't say you can't buy. It says you cannot sell it. And it's a very subtle distinction, and this is why it's so complicated. So now, let's say that you turn around and you sell your $5,000 worth of XYZ stock on Tuesday. So you bought it on Tuesday, and you sell it later on Tuesday. Now you're going to get hit with a free ride violation, and that's going to lead you to a 90-day cuff restriction. So how did this happen? Well, here's what happened. On Monday, we did our sale, and we have proceeds coming in. However, on Tuesday, we do the purchase of XYZ, but then we did a sale of XYZ also on Tuesday. Notice that we have sold them before we received the money. They were not fully paid for. Why? When did our settlement come in from the sale on Monday? They came in on Wednesday. So we bought and sold before we fully paid for them. And that is called free riding. And essentially what you're doing is just speculating with the market's money. So they want to make sure that these are fully paid for. So in this case, this would be a free ride. So here's what happens with the free ride. Remember, it is a mandatory 90-day cash upfront restriction. Sales are permitted, so if you had other securities in there, you could certainly close them out. If you're going to sell a security to generate the funds to do a buy, you could not do that either. However, you could make purchases under this 90-day cuff, but you must fully pay with cash on the trade date. So again, not from the sale of other securities. So you can avoid cuffs by fully paying for each trade on the settlement date. So if you have a cash account, you got tons of money, every time you buy a stock, you turn around and just deposit the funds for that on the settlement date and you'll be fine. But again, this sometimes is not going to be realistic for most people. They want to sell some security and roll it into something else, and that's where the free rides start to happen. Now, liquidation is a very similar idea. It's a T+2 settlement issue, but the arrangement is just slightly different. So let's say that you buy $5,000 worth of ABC stock on Monday, place a trade in there, and you say, yeah, I've got other stocks in my account, I'm going to sell something to pay for it. But you sell $5,000 worth of XYZ on Tuesday. So you've sold the stock to cover the purchase of another, but the settlement dates are not going to match. And that is called a liquidation and will also lead to a 90-day cuff. So here's the way that a free ride looks graphically. Let's say we did our purchase of ABC stock on Monday the 9th. We didn't have any other funds in the account, but we just did that buy. And we're free to do that because we have until Wednesday to settle the trade. If I did the sale on the 9th as well, I would be fine because both of those trades would settle on Wednesday. But in this example, I'm saying, yeah, I did this purchase of $5,000 of ABC on Monday the 9th, and I will sell some funds to settle that trade, but I do it on Tuesday. Notice that the settlements are not going to match. On the 11th, T+2 for my buy, they're going to be saying, where's the proceeds? We need the money in the account. When will it be there? On Wednesday, because we did the trade on the 10th, and that will not settle until the 12th. Now notice that your two T+2 dates don't match. But because we did a buy and then we covered that purchase with the sale on a different date, it's just really a technicality in there, and that's what makes it a liquidation. All right, so how can options resolve these problems? Well, there's a number of ways. I've talked about the stock replacement strategy before. We get great leverage, we get limited downside. There's really no reason that people should be trading shares of stock. But in addition to that, options have T+1 settlement. They settle the next day, very much like bonds. And as I mentioned before, options must be made in a margin account. So if you happen to buy, let's say, shares of stock that have a T+2 settlement, but you've got a margin account just in case the settlement dates don't match, you might end up paying a little bit of margin interest for a day or two. It's not going to amount to much, but at least the cash will be there to meet settlement, and you'll never have to worry about free rides or liquidations. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.